Joe, do you have a silver or gold allocation in your portfolio?
I have from time to time, very, very small. I also, when I did research around, believe it or not, Paula, the efficient frontier,
Oh.
I found that having just a little tiny bit is like if you add just a little bit of chili pepper to the recipe, a little goes a long way. But it's funny because of the non-correlation with equities and sometimes negative correlation, it really mellows out your portfolio.
Ooh. All right. Well, we're going to hear from a listener who's wondering about adding a silver or gold allocation. We're also going to hear from someone who's wondering how much is too much to save for kids' college.
Never too much. Save more.
And we'll hear from someone with some questions about retirement, the 4% rule, the efficient frontier, all of our favorite topics. So it's going to be a meaty episode.
Meats.
We'll try not to get the meat sweats. Welcome to the Afford Anything podcast, the show that understands you can afford anything, but not everything. This show covers 5 pillars: financial psychology, increasing your income, investing, real estate, and entrepreneurship. It's double I FIRE. I'm your host, Paula Pant. I trained in economic reporting at Columbia. Every other episode, I answer questions from you, alongside my buddy, the former financial planner, Joe Saul-Sehy. What's up, Joe?
I don't mind the meat sweats because if you have them, you earned them. Like, you know what I mean? You get to sit at a table and just mow. That's not a bad thing.
Anything you earn is always much more gratifying than anything that's given to you.
It certainly is. What's that one comedian that's like, I don't stop when I'm full, I stop when I'm ashamed of myself.
Well, speaking of not being ashamed of yourself, how do I segue from there?
I don't know. There is no segue.
Speaking of a shameful segue, our first question comes from Bethany.
Hey Paula and Joe, my name's Bethany. I'm in my mid-30s and I'm calling you from Australia. My partner and I have been together for over 5 years and we have fairly combined finances. He is originally from the States and lately we've been talking about having more of a joint investment strategy. We both have our own separate investments and my partner is really interested in investing in silver and gold, and he doesn't feel very confident in the stock market or investing in index funds or any of those sorts of investment vehicles. He would like as much of his money as possible to be invested in gold and silver. But I never really hear anybody talking about investing in gold and silver. And so I'd just really love to get your opinions and anything that I should know, red flags, things I should look out for. Besides the limitations of obviously filling our house up with gold and silver, there's only so much storage. I appreciate that that's a big limitation, but is there any other things that I need to be keeping an eye out for? Thanks.
Storing it at home too is a mistake.
Right. Yeah.
Seriously, if you're going to have gold and silver, find a very safe place for that. Do not keep it in your house.
Yeah. The security risk.
Oh, too much. Do not keep gold and silver in your house. But anyway.
I had this visual of them getting like a mine in Cooper Pedy, right? And just having like this trove of opals and all kinds of beautiful rare earth minerals.
Awesome. Yeah. Sounds pretty.
Yeah. But there are some red flags to gold and silver. Gold and silver are both examples of commodities. They're great for having a very, very small, like Joe was saying earlier, like spice in your food. It can be a wonderful accent that really elevates a dish, but it's not the main course. And the primary reason for that, there are a few. Partially, it's the volatility of the asset. I mean, just look at the historic performance. Partially, it's that it's unlikely to be able to produce the types of returns that you need to be able to support you through your retirement. When it comes to the world of not just gold and silver specifically, but commodities investing more generally, commodities do not perform like equities. And all of our assumptions around retirement planning and long-term investing really hinge on having a strong equities, meaning companies, portion of your portfolio.
Yeah, the first thing here is what you're comfortable with. And I think comfort, Paula, comes with education about how these assets perform. And the more you know, the more comfortable you're going to be. I'm very uncomfortable with things that I don't know a lot about. And so let's look first at the goal. If the goal is And I think for 99.9% of us, it needs to be to beat inflation with investments, right? If our main goal is to beat inflation, we have to look at historically which asset classes have done that. If we don't beat inflation, let's look at the downside first. We'll do the stick first, and then we'll do the carrot, Paula. The stick here is if we don't beat inflation, we have to save at least dollar for dollar every dollar we're going to spend later.
If we don't beat inflation, inflation beats us.
It does. I mean, think about if I want to be retired for, let's say conservatively, 30 years, right? And I want to live on 50, 60, 70, $80,000 a year. I've got to save 80,000 bucks on top of whatever money I need to live on today. So let's say I want to live on $100,000 today and I need to save another $80,000 for later. I got $180,000 after tax I got to somehow come up with to do both things.
Well, and if you want to live on the purchasing power equivalent of today's $80,000, I mean, in the future, with inflation, that's probably going to be more than you currently make.
Sure, absolutely. And I guess in my example, Paul, I was just thinking about if we invested it in something that just met inflation, which, by the way, that's what gold and silver does over long periods of time. And I'm going to explain why here in a second. But I think we need to look at things that have done that. So what has done that? Equities, stocks, which he's uncomfortable with. And then second, real estate, which we didn't talk about, specifically like rental real estate. Certainly the value of your primary residence doesn't do the same, doesn't work that way. But stocks and real estate are the two big things that do that.
Mm-hmm. And that's true both in Australia and in the US.
Yeah, it's true worldwide.
Yeah, exactly. I will say, just because since you're from Australia and we're talking about real estate, or we're mentioning it, in Australia specifically, there are certain tax laws that people use to justify being negatively geared on a property, meaning negative cash flow. I don't care what the tax laws state, do not seek to be negative cash flow. I understand that sometimes it happens, every now and again, you have a big expense. And so for a year or two, you might be negatively cash flow. That's normal. That happens in every company. That happens in every business. That's not what I'm talking about. I mean, don't run out to buy a property that you know is going to be negatively cash flowed in the long term. And in Australia specifically, people will use the tax code as a justification for that. So that's my little Australia asterisk that I'm going to put here.
Little Australian caveat.
Yeah, my Australian caveat.
In the mix. Let's talk specifically, though, Paula, about gold and silver. And I'm going to borrow this specifically from one gentleman who made the case better than any I've ever heard before. His name is Peter Mallouk. He wrote a book called Unshakable with a gentleman that a lot of our listeners have heard of, Tony Robbins. It was a personal finance book. Peter and Tony wrote it together. So Peter, by the way, runs one of the top financial planning organizations in the United States, fee-based financial planning in Kansas City. He also has done well enough. He owns the Kansas City Royals, which for those of you in Australia is an American baseball team. So this dude has done very well and knows his stuff when it comes to personal finance. Peter said to me on our show, I said, why don't you want to invest more money in things like silver and gold, Paula? And he said, silver and gold are phenomenal stores of value. They're over long periods of time. He said, if you were going to buy a very nice suit in the 1600s, X amount of gold would buy a very nice suit in the 1600s. Today, that same amount of gold will buy the same suit. It hasn't moved. The X amount of gold then equals X amount of gold now. So if you want to store value, and his analogy was, if I have a time machine, I can go 1,000 years in the future. Heck, I don't know what stocks are going to do well 1,000 years from now. I don't know if indexes are going to be around. So I'm not taking my index funds. I'm not taking any stocks. I'm not doing any of that. I'm grabbing gold because I know that gold in the year 0 in the year 500 BC now is worth about the same. So I can take the gold in my time machine and I can go way in the future and reasonably bet that it's going to continue to do what it's always done.
This is what Joe's packing on his space shuttle to Mars.
I'm on my way, baby. But that's not our goal. Mm-hmm. Our goal is to beat inflation. Over long periods of time, stocks do that far better than gold. Gold and silver does not do that. And so I think it's a big mistake. I don't think it's a little mistake. I think it's a colossal mistake to invest all your portfolio in gold and silver.
Yeah. And Bethany, what I want to dig into is why he's uncomfortable with stocks. Because oftentimes when people say that they're uncomfortable with stocks, sometimes they mean that they're uncomfortable with individual stock picking, which great, wonderful. I'm uncomfortable with that too. You should. A healthy attitude towards individual stock picking is to be uncomfortable with that. That is exactly the proper response. A person could go their entire life never buying any single individual stock, and they would have a wonderful portfolio, a great net worth, a healthy retirement. You could meet all of your financial goals, never getting into the individual stock picking game. So stocks, or shares as they're also called, you don't need to pick individual stocks or individual shares. Just stick with broad market baskets of funds, stick with index funds, and you can have a wonderful life doing just that.
But you heard her, Paula.
Mm-hmm.
He's also uncomfortable with index funds.
And that part, I don't understand. I'd like to know why.
I think that's more of an educational
Yeah.
piece.
Right. The last major worldwide crash was the Great Recession of 2008, 2009. And what I often tell people when they are worried about the broad market is, imagine that you had invested a huge lump sum of money on January 1st, 2007, right? Imagine you invested a huge amount of money in one big chunk right at the peak or near peak of the market, right before everything started crashing. If you invested that money January 1st, 2007, and you held through today, you'd be doing great. You'd be doing absolutely great. And that's the worst case scenario, right? That's buying at the top.
Yeah, as I'm listening to you, I'm even thinking about starting there. Like if I'm educating someone who is worried about stock market crashes, and clearly we don't know that, but it's a good assumption because that's generally what most people are worried about. What if the stock market crashes? I think we actually start there, Paula, too. I think we start with, no, it's not if, it's when, because it will happen.
Right.
It 100% will happen. We will see this happen again, and depending on Bethany and her partner's age, it could happen once, twice, three times. As an investor, I've been through two big ones, and 2022, not that big a deal in hindsight, but at the time didn't feel great.
Well, and 2022 was weird because that was the year that stocks and bonds moved in tandem. And so a lot of people will asset allocate between stocks and bonds thinking that the two are going to move inverse to one another, meaning when one goes up, the other goes down. In 2022, they both moved together like twins.
It was a great lesson for some of us in the hardest way possible, but yeah.
Yeah. So 2022 is one of those years where even having a bond allocation, even having some debt instruments, which is what bonds are, wouldn't necessarily remove the volatility or as much of the volatility from your portfolio, but 2022 was just one year. I think that the bigger lesson is that you don't judge the performance of your portfolio based on what's happening in a month or even a year. You judge it based on how it performs over decades. And it's the same for the way that you would judge a company, assuming that it's stable enough, assuming that it's not going to face bankruptcy. Every company is going to have its ups and downs. Heck, the way that you judge if you're being judgy towards a sibling, right? How do you ultimately judge if your sibling is like someone you're proud of versus like, my loser brother, right? You don't judge what they've done in a year. You look at what they've done over the span of their life. And you're like, you know what? My brother had a couple of tough years, but then he really pulled himself out of it. And now he's doing great. And then, right?
That's funny if your brother was the S&P 500.
Yeah.
Back in 2022, my brother had a bad year.
Yeah.
It wasn't good, but 2023, my brother came around.
Exactly.
2024, pretty damn proud of what he did in 2024. I like that a lot.
Yeah, exactly. And you know what? Maybe the brother has a little bit of a slip up again in 2025, but that's okay because he's going to get back on his feet in 2026.
I'm confident. I know.
I use that analogy because it is just an analog to a long-term relationship. And that's the way that you've got to think about the relationship with your index fund investments, with your equities investments. It's a long-term relationship.
Well, and I love that analogy, but then, the engineers out there are going, well, why would I be confident? Like, how do I know? And I think this is where we go back, and let's just stick with stocks here. The reason stocks beat inflation, and it's because of the profit motive of the company. If the price of sugar goes up, Coca-Cola does not say, we're screwed. Coca-Cola finds a way to make that profitable. Either that or they go out of business.
Right.
It's not voodoo. I think that's the big problem people have with the stock market when they're first starting out. It just feels like voodoo. You watch these talking heads on CNBC and Fox Business, and they're going blah, 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 blah. Your earnings per share, blah, 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 blah. Technical analysis up, blah, 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 blah. Oh my God, everybody is, and all this crap. And you're like, what? This is a foreign language. And it just seems like a bunch of mumbo jumbo. And the cool thing is as more seasoned investors know, the second you take all that mumbo jumbo and throw it in the trash,
Yeah,
better off you're going to be.
exactly. Because there are huge industries out there that make a lot of money by making you think that it's scarier than it is and that it's more complicated than it is. There are a lot of people who earn their paycheck by scaring you and overwhelming you so that you will throw up your hands and say, you know what, you just handle it for me. And then they can take a big fee for doing that.
And I love this vein because I do think that beginning with it will happen and facing that fear right in the face and going, what can go wrong? And let's look at all those things that could go wrong. And I think that educating yourself from that perspective, for me anyway, gives me a lot of comfort because I know that we've got all of these ways to protect ourselves when things go wrong. It's the reason we say stocks for the long term, but not for the short term. That's a way to protect yourself. Indexing versus buying an individual company, that protects yourself. So if we stare all of these risks in the eye and we look at them and we understand why things are going to go foobar and protect against them, then we become a much stronger investor. Because I actually think, Paula, that fear as an investor can be a really good thing. Scaring you, not good. But being a healthy amount of afraid, I think is going to help you set up a stronger portfolio.
Yeah, absolutely. Because it's that healthy dose of fear that keeps you from turning to these wild speculative assets.
Yeah, 100%. And it's the reason why the more you look at this analytically and you get scientific, it's the reason why I turned to the efficient frontier when I was a pro. It's also the reason why I turned toward investment policy statements and putting it in writing. Because if I put my investment approach in writing, I'm much more likely to dig and get a little more analytical about what's the machinery. If I think about it as machinery instead of emotional, it's better. And also, when the market goes sideways, I'm not wondering what my plan is. I set a plan up when I wasn't emotional. And now that I'm emotional, I go, nope, I got to let it sit for the next 3 months because that's the next thing on my investment policy statement. Pretty cool.
Yeah, exactly. And I want to go back to, Joe, something that you said earlier, because I can see somebody who's listening to this think, well, wait a minute, but what if Coca-Cola does go out of business? I mean, wouldn't that just have these huge ripple waves and everything would come crashing down? But the beauty of an index fund is that if Coca-Cola goes out of business, then Pepsi-Cola is going to step up and take that market share. And if Pepsi-Cola doesn't do that, then some other company will.
This is what I love about indexing,
Yeah.
Paula. I love this about indexing is I don't have to pay attention to that.
Exactly, because the index is self-cleaning.
Yeah.
So meaning if Coca-Cola goes out, like whoever is the leader of the soft drink industry is going to be in that index. And I don't even have to think about swapping them in and out. Like the index is just going to handle it for me. It's all automated. It's all just being done.
If you want a front row case study right now, look at what's going on with Southwest Airlines. Because Southwest Airlines just got rid of their free bag thing. You're seeing them, you're seeing people as big as Clark Howard putting these social media posts out about how bad that sucks. And they are getting ripped. So, and rightly so, right?
You know, people hate it when they have a thing and that thing is taken away.
Absolutely.
It's worse than never having had it in the first place.
Yeah. And if we want to look at the self-cleaning, look at what Frontier Airlines did a few weeks ago. Frontier Airlines ran a special through the end of the summer going, we're doing bags for free. And you know what happens, Paula? To your point, Coca-Cola is not the leader. Pepsi steps up.
Yeah.
Southwest Airlines says, hey. Frontier Airlines says this is an opportunity. In fact, it's funny. A friend of mine is friends with the CEO of Spirit Airlines, and the Spirit people were high-fiving themselves saying, this is an opportunity for us. This is an opportunity.
Right.
Other companies will step in. And the bad news is we got to get used to as customers, maybe Southwest isn't the thing anymore for us. Maybe Frontier Airline, I don't know. Maybe Spirit is. Maybe some other airline steps up, but somebody's going to take that business away that Southwest is giving away right now.
Right. And there's all the chatter about Spirit possibly merging. There was talks of Frontier and then JetBlue and then this or vice versa. And so like there's always deal making happening behind the scenes, and all of like the upside and downside of all of it gets represented within that index.
It's pretty wild that we have that happening right now as we're focusing on this topic. Like, look at what's going on in the airline industry today.
Yeah.
As Bethany brings up this question.
Right. And so, Bethany, here's what I would encourage you to do, or to encourage your partner to do. Look at a chart of the ASX 200, the top 200 companies in Australia, and go to the 20-year view. Because the 20-year view, it looks a lot like the total stock market index or the S&P 500 in the US. The 20-year view is up and to the right. You see the big tumble at the Great Recession in 2008, 2009. And then from that point, you just see growth, growth, growth. And so taking that 20-year view, I think, can calm a lot of fears, particularly when you're looking not just at the Australian market, but also at the US market and other worldwide markets. When you're looking at diversifying across a wide spectrum of different indices, you get that diversification, you get that smoother ride. So play around with that, put it into a couple of model portfolios, run it through a couple of retirement simulators. Like, what's cool is that there's so many tools that are free online where you can just make a couple of assumptions based on historic returns about how much money you would put into a given stock index, and you can model out what that would mean for you over the span of the next 20, 30, 40 years.
And circling back to that chili pepper analogy that I had, Paula, and I haven't looked at precious metals in a portfolio in quite a while, but that number historically was around 3 to 5% of the overall portfolio, never more than 5, and usually less than 5.
Yeah. So thank you, Bethany, for the question. And best of luck with developing that comfort with equity index funds. Equity is just a fancy word for company index funds.
Great question.
Up next, we're going to hear from Diana, who has 3 kids between the ages of 7 through 13 and is wondering how much is too much to save for college.
There's no such thing.
Our next question comes from Diana.
Hi, Paul and Joe. My name is Diana, and I'm calling to ask you guys a question about college savings. We have 3 children, ages 13, 11, and 7. Our oldest son, we have $150,000 in a 529 for him for college. He's 13. We expect he will be starting college in 4 to 5 years. My question is, can I save too much? We have been contributing $600 per month per child, so $1,800 per month total to the 529s since they were born. And I'm wondering if I should cut this back or stop altogether with the expectation that it should grow some close to his 18th birthday, and we may be able to supplement the rest with cash. I would love your advice on this and risk of saving too much. Okay, thank you so much. Bye-bye.
First of all, Paula, cautionary tale here.
Mm-hmm.
Think about this. Saving for college, an appropriate amount of money to save for college per child, $600 per month, which I do think is an appropriate number. And I think, Diana, it's kick-ass that you did that, but $1,800 a month. If you have a young child, and you're not saving $600 a month. Yeah. But for people not watching us, Paula's eyes just went. It is so expensive, Paula. It is so expensive. So I actually do think she might have saved too much. However, I think it's just amazing, that type of preparation. But if you're not preparing for college, get ready to lose all your hair and look like me.
Aw. Well, Scott Yamamura, who was a guest on a previous episode, he talked about the rule of 72. And rule of 72 states that the amount of time that it takes for money to double, this is kind of a rough back of the napkin calculation, but the amount of time that it takes for money to double is 72 divided by the interest rate at which that money will grow. So, for example, if you expect that money will grow at a long-term annualized rate of 8% per year compounded, that means that 72 divided by 8 equals 9, which means that money will double in 9 years. So let's take that and apply it to college savings. Let's say that the amount of money that you save, if you make a return assumption of 8%, and you might argue that's too high of a return assumption, we should dial the return assumption down lower. We can have that argument in a moment, but let's just hang with me for the math for a moment. If you make a return assumption of 8%, then whatever you have saved in the child's portfolio by the age of 9 would double in 9 more years when that child turns 18. So the balance of the portfolio at the age of 9, if you're making an 8% return assumption, should be roughly half of the total amount that you want to save by the time that child is 18. So let's say that the goal, and this is the part, Diana, that I didn't hear in your question, is what is the goal amount at the time that the child turns 18? Let's say that that goal amount is $100,000. That means that by the time the child is 9, assuming an 8% return assumption, you would want to have $50,000 saved. And so then pull the first 9 years of compounding returns out of it and just run an extremely simple calculation. $50,000 over 9 years, assuming zero returns, right? Assuming just pulling all of the returns out of it, looking only at the cash that you would need to save $50,000 over 9 years means that you would need to save $462 per month. But obviously, that money is going to be growing over the span of the 9 years, so you wouldn't even have to save $462 per month. It would be less than that. And so, I'm with you, Joe. I think that she saved too much. But again, I'm assuming that $100,000 is the balance that she's aiming for.
Sure. Yeah. We don't know what that finish line is. And I love begin with the end in mind.
Right. So if that balance, the finish line is 150,000 rather than 100, that changes the equation.
And the issue with the 529 plan in general is that the uses are so limited. It has to be money that's for the cost of college or qualifying expenses around the college. So either going directly to the school or there's a laundry list of pretty obvious expenses that are college related, right? The good news is the Secure Act changed this a little bit, which is that if you don't use that money for college, now there's opportunities to change that into Roth IRA money. But I'll tell you, Paula, I really like if Diana feels like she's been saving too much. I almost said we've been saving too much, as if I had something to do with it. We've been saving too much. Diana, you and I have been saving too much money, mostly you, but I love just the brokerage account. I like still saving the money. Here's what happens when people dial it back. When you dial it back, that money just goes into your budget, goes into your checkbook, does nothing. I like the fact that you've been directing it. So let's continue to direct it, but direct it into a place that is much more flexible. And this is, by the way, something for any goal. I mean, it doesn't have to be for college. If you're going into a specific place, like let's say a Roth IRA or a 401k, if it's for your financial independence goals, how many times have we said, supplement that by having money go into a brokerage account? So we've got the gift of flexibility. We don't have the tax shelter, but we've got flexibility, which is really cool on its own. So I would still keep saving the $600 a month. If she's built that muscle, I wouldn't let it go. I would just have that money go into a brokerage account instead after she does the homework that you're talking about. How much is too much? But even Paula, with that homework, I'm going to talk about another side of this. Like I'm thinking about my awesome niece who is a senior in high school this year. She applied, Paula, to 5 different small liberal arts colleges, private liberal arts colleges. They are not cheap. And she got nearly full rides to all 5 of those because, she's amazing, mostly because she's related to me, right? Of course. So she now has all this money in a 529 plan. And Paula, she's going to use almost none of it, almost none. Now, the cool thing is that her parents are already talking about, hey, what a great Roth IRA to start with, right? They're going to change the ownership name to her, and then she will have this beautiful Roth IRA that's going to give her this leg up that she might not have had she not had her parents save this money. So it's still going to go toward her, but not toward the college education. It's going to go further out. But man, if that were in a flexible place, it'd be a lot easier.
Well, the advantage that Diana has is with 3 kids, so I'm thinking the 13-year-old child, right? If Diana's been saving $600 a month from the time the child was born, that means that her contributions to the account are $93,600. And that's just the contribution of $93,600. That doesn't count all of the gains that money has made over the span of the last 9 years. And the last 9 years has been primarily bull market. So that money has grown pretty substantially. And so if she is overfunded for the 13-year-old, then she can always change the beneficiary on the 529 to be the 11-year-old or the 7-year-old.
But if she's saving $600 for them too, she's in the same situation with them.
Right. But for the youngest, who's 7,
yes,
she can probably stop saving for that child. And
she could do that.
There's a good chance that child, the 7-year-old, can get the hand-me-downs from their older siblings. Money. Yeah.
Yeah, that definitely is a good idea. I love the fact that a lot of people don't know that you can change the beneficiary on your 529 plan.
Right.
So you can make it so that it's not this child, it is another child. In fact, if you go through children, you can make it you. If you want continuing education, if you've got some cool thing you want to do at the local university, if it's an accredited institution, if it's an accredited higher education institution, it could be cooking classes, it could be golf lessons, it could be flight school, it could be all kinds of things.
Or it could go to grandkids.
It could do that too.
It has to go to an actual living person. It can't go to a hypothetical person. So it needs to go to somebody who has a U.S. Social Security number and is living, but it's not time restricted. So you can always wait until the first grandchild is born and then put it in the grandchild's name.
And then it becomes like the Diana Education Trust.
Right.
For all purposes, it's like an education trust. Pretty cool. But a great problem to have. This is a wonderful problem to have, was that you took it seriously early on, possibly overfunded it.
Yeah.
Not a bad issue.
Yeah. But Diana, to your direct question of how do you know if you've overfunded it or not? I mean, my first question back is, what goal amount are you setting? Because again, if the goal amount is $100,000, then you've overfunded it. If the goal amount is $200,000, all right, now we're having a different conversation.
There is a reason, by the way, Paula, that a lot of parents that are doing the right thing overfund college. And I saw this firsthand as a parent, which is that some of the college cost is not new expense. And I see people fall into this. So I'll give you my personal example. My son, Nick.
Oh, I know what you're about to say. Your grocery bill.
Oh, my grocery bill was so high. It was so high. When I saw the amount the University of Texas was going to charge him for on-campus food, I was like, my kid and I are going to win this together because University of Texas is losing. And Paula, you've seen Nick and he's not a big dude, but that guy can eat. It is amazing how many calories he burns with his workout routine and whatever. But Cheryl and I found that when Nick went to college, this money I was spending in groceries, now it's just a cost transfer. I was still spending it, but now I was spending it toward part of the room and board bill to the University of Texas instead of here at home. And actually, frankly, it ended up being less money I paid for food than I paid when he was home. So some of those room and board costs, not as egregious as you think they're going to be. I think sometimes we get really afraid when we look at, you go to savingforcollege.com, which is a fantastic place to look at the cost of college, responsible 529s, what the fees are going to be on 529s, all the different plan options you have from different states. Really, really like this website. When you go to a place like that and you see all these costs and then you put those into your calculator and you include the room and board, you come up with this huge number.
Well, if you think about it, you don't often see your grocery bill expressed as if it's semester, 4.5 months, or if it's a year, 9 months, 10 months. You don't see your grocery bill expressed in those types of increments.
No.
And, and so, like, you tend to think of your grocery bill as weekly or biweekly or at most monthly, but you never think of your grocery bill in increments of semesters. And so when you see that number, it looks like a huge number.
Monster number. Yeah. And then you go, wait a minute. Oh my goodness, I'm already spending that.
Yeah.
I love the idea though of cutting the 7-year-olds 529 first,
Mm-hmm.
and then having the water kind of spill downhill.
Yeah.
The overflow spill downhill.
Yeah.
I like that idea.
Oh, thank you.
Yeah, that's good.
Thank you. I'll be here all week.
One thing I like too for diversification purposes, because of the fact that you can change the beneficiary, Paula. One thing we did with our twins that I still advocate for people, maybe not for Diana, maybe for, I don't know. I like using different custodians for different kids just because of the fact that different fund companies have different strengths and weaknesses, and knowing that I can mix and match at the time. So I used the Vanguard Utah plan for my daughter, and I used the New Hampshire Fidelity plan for my son. And we ended up using the 529s for both of them, which was pretty cool because then I got Vanguard and Fidelity. I wasn't trusting one fund company to take care of all of my college money. And this may seem like a little thing, but there was a time when Worth magazine, I don't even know if Worth is still a magazine. Worth used to be a huge magazine in personal finance. Worth magazine had a cover story that said, "Is Fidelity dead?" Because the Fidelity management team, Paula, went through this rut back when everything was managed, right? There was very little indexing going on. The Fidelity team was all doing research through the same place, and Fidelity just stepped in it research wise as a group. What was also interesting was that Fidelity at the time was one of the biggest advertisers inside of Worth magazine, and it showed great editorial balls, I guess, to be able to say, who cares who our advertisers are? We're going to still ask this question, which was a huge question. Made me really appreciate the editors at Worth magazine at the time that they published that. Now that's not going to be the case as much anymore with indexing, but still, if something bad happens and I have this opportunity, why wouldn't I? And 529s are not the type of thing where I'm going to go touch them or move money around all the time. So having one at Fidelity and one at Vanguard, okay, maybe bad things won't happen, but if it does, I've got this extra layer.
The last thing I'll say, Diana, is that if you waterfall the 529 balances down and you still end up overfunded for the 7-year-old, then there's always the option of using some of that money if any of the kids want to go to graduate school. This doesn't necessarily have to be undergrad money. So there's always the option of using it for grad school. There's always the option, as we talked about before, using it for grandkids after they're born, after they have a social security number that you can associate with the account, or using it for yourself. So there is actually a lot of flexibility in the 529, which is one of the great things about the account. You get tax deferred growth, but you do also get quite a bit of flexibility.
Or there's always a popular option, Paula, that we haven't explored yet, which is just send it to your favorite podcasters.
Why would she send it to Alex Cooper?
Oh, hey. America's second favorite behind us, right?
All right, well, thank you, Diana, for the question. Our final question today comes from a caller whose pension and Social Security will cover all of her basic expenses during retirement. So she's wondering, does the 4% rule still apply to her discretionary money? Our final question today comes from Wendy.
Dear Paula and Joe, I really enjoy your show and the depth and breadth of your answers compared with many other podcasts. My question is about asset allocation if you have a portion of your retirement income covered by secure sources versus if you are living off your nest egg nearly 100%. Whether you use the 4% rule or various other methods of drawdown with guardrails, the assumption is if you are relying on your lump sum to last the rest of your life, that your nest egg is usually invested in a portion of equities and some safer investments like bonds or cash equivalents, usually with equities making up 50 to 75%. I understand for the equities portion, you can use a low-cost index fund or diversify a little with efficient frontiers approaches. But what if this lump sum is not needed to produce a guaranteed minimum amount of each year that you must withdraw to live? Our details. My husband and I will retire at age 59 and a half with a pot of conservatively invested, dedicated money to take us to age 65 to 66. At that time, we will then have income from pensions that are not cost of living adjusted, but that generate $100,000 a year for life for both of us, plus Social Security for conservatively another $70K if it is still paying out the estimates that SSA website states we will have earned. Our base budget to cover all of our needs, what some call the minimum dignity floor, will be fully funded. This includes all our healthcare, housing, food, transportation, energy, and a bare minimum of travel, gifts, and entertainment. We do have another budget of $100,000 to $125,000 a year of fund money that we plan to use for extensive travel, gifting to our kids, and bringing our standard of living up to about $300,000 a year, which matches our current level of spending. But this fund money can absolutely be calibrated or even not taken at all in a given year if the market is down. My question is, if you have a pot of money and you want the most growth over decades without excessive risk, is a four-fund efficient frontier approach the best way? Do we need to have any of this money in bonds at all? A last point, in addition to these two buckets, of guaranteed income and nest egg income, we also have $2 to $2.5 million in real estate equity that we are not including in our calculations. So in the unlikely event of the world is ending, worst case scenario, like no Social Security or the pension goes bankrupt, we could downsize our real estate assets and simplify our lives dramatically and still not have to eat dog food to survive. Thank you.
And no one wants to eat dog food to survive. So Wendy, I'm glad
speak for yourself. Speak for yourself.
Gourmet. Wendy, it sounds to me as though, and I get the sense that you know the answer by the way that you've described the question, but given that you don't actually need this money, you're not going to be affected by sequence of returns risk, because if there's a down market right when you retire, you don't have to touch your portfolio. Therefore, sequence of returns risk is not a risk. And with that risk eliminated, you can take on a heck of a lot more risk in your portfolio. I was about to say aggression. I was like, that's not the word.
Yeah.
But you can be much more aggressive in your portfolio. So no, you don't need a bond allocation. You can maintain an equities position because you don't have sequence of returns risk looming. You've eliminated that. So go ahead, be aggressive in your portfolio, grow it as much as you can. That's the opportunity that's available to you by virtue of the fact that you have flexibility and can adjust downwards when the market is down. But especially if the market is down in the first 5 years of retirement, those are the critical sequence of returns years. And by being ultra flexible during those years, you've eliminated the bulk of retirement withdrawal risk.
I'll only hedge what you're saying, Paula, in two ways. The first one is, I think if it were me, I would just keep a little larger cash cushion, because if you do go through an extended downturn and you don't want to take it, I think you can afford to do that if you are staying completely in stocks and you're very flexible. So a little bit, Paula, of an approach like you use, or my co-host on Stacking Benjamin's OG, a little bit of a barbell, where you've got a little bigger cash reserve than a lot of people have. The second thing that I would look at, since you're comfortable with the efficient frontier, is that I would just look at the what's called the standard deviation on that portfolio just ahead of time to know what the bouncing around is going to be. Because what you're talking about is really making a portfolio that's going to have significantly higher highs and significantly lower lows than you may have had in the past, depending on where you're starting. And I just want to know that ahead of time, what that flight plan kind of looks like, because during those lows, if you're 100% equities, it's going to suck. And the only thing that I don't worry about the plan at all. I'm 100% with you, Paula. Don't worry about that plan. It's a beautiful thing. If you can stay in equities, and when you're modeling the efficient frontier, just cut all the bonds out and say, put me along the efficient frontier, all equities, baby. Go, 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 up and to the right. I'm great with all that. What I'm not great with is you, because I don't know you and I don't know if you're going to blow that plan up when the market seems like it's in this unrecoverable position, which is what happens at the bottom. It's 100% what Bethany's partner is worried about, right? Is that you're going to get to this black area where it looks like there's no upside, which you and I know sitting here today is the time of greatest opportunity. But at the time, it feels like the time of greatest risk.
So, Joe, you're not worried about the math of it. You're worried about the behavioral psychology of it.
100%.
Right. And that's going to be very highly individualized because only you know yourself well enough to know how you're going to handle that. And I think the best way to get a sense of that is to look at your own past performance, your own behavior during the Great Recession of 2008, during the pandemic. You know, the pandemic recession, it was a short one, but it was a sharp one, right? When you think about recessions, there are really three characteristics that define any recession. There's severity, there's duration, and then when it comes to multiple recessions, there's frequency. And so the recession of 2020, the pandemic recession, was one of short duration but massive severity. How did you react? Because the way you reacted then is going to be a powerful insight into how you are likely to react in the next one. And then you go back to 2008, that was severe severity, but it was also long duration.
Yeah.
And so it gives you a window when you look at your behavior across both of those, it gives you a window into how you will react to severe recessions and how those reactions might change depending on the duration of the recession.
And something else is going to change too, Paula. And I think there's a couple of reasons for this. I have some hypotheses, which I'm happy to dive into. But I also think that our risk tolerance goes down as we age, even if we don't need the money. I think so. I think my hypothesis is on two fronts. Number one is I think that the popular media, and we're always inundated with, when you're older, you need to be more careful. And even if you think that doesn't affect you, you hear it so many times that I think that it does. I think the second thing though is that even without that, I think that you realize that your opportunity to wait becomes less as you age. And I think that one is a very real thing. So I think number one is learn behavior from everybody around us telling us over and over and over. But I think number two is you're like, oh, do I wait 2 years on this trip? Or do I go ahead and take it when I'm down 35%? Which is another reason why I think I keep that extra large cash cushion.
Right.
2 years feels a lot different at 30 than it does at 72.
Right. And, you know, one of my favorite components of your question was when you talked about that fun bucket, that flexible bucket of money that you would use for extensive travel, for all the fun stuff. I would encourage, as you're thinking through your spending in retirement, to pull out a couple of buckets like that. This is actually a tip that comes from Christine Benz, who's also a former guest on this podcast. We'll link to her interview in the show notes so you can hear it in its entirety. But I flew out to the Bogleheads conference in Minneapolis last year and sat down with her and talked to her about retirement withdrawal strategies. And one of my favorite tips that she offered was to have a dedicated bucket of money for some specific retirement goal and have a goal of spending down that entire bucket. Treat it almost like it's a flexible spending account, use it or lose it. in that your goal for this bucket of money is that you want that bucket to be empty within X number of years. So maybe that's 5 years, maybe that's 10 years. But the value in having a particular bucket of money that you are committed to whittling down to zero is that number one, mentally, it puts you in a very different state. Now you're no longer thinking about growth. You're thinking about, I have to blow through this. My goal is to blow through this particular bucket of money. And what that does is it encourages you, especially at the beginning of your retirement, when you are likely going to be in the best health and have the highest levels of energy that you have, it encourages you to do that spending up front. So let's say that from the age of 59 and a half to the age of 64 and a half, during that 5-year window, you have some bucket, some portion of money that you're like, I must spend this by the time I'm 64 and a half. If I turn 65 and there is even a dollar left, I will have failed in that goal, right? By virtue of doing that, you end up living more life in those first 5 years of retirement. And when you're in your mid to late 80s and you can't travel in the way that you could when you were 61, 62, 63, you're likely going to be pretty happy that you did it.
I love that approach. I also remember, and I think, Paula, you and I may have discussed this before. So for people that are new to the show, I'm sure you haven't heard this though. And if you have heard it, I think it's a good reminder. I love Paul Merriman's approach too. When the market goes up, he and his partner, they travel the world. And when the market goes down, they appreciate all the wonderful local things that are happening in their backyard, which is just a pretty fun way to gamify it as well.
Right. And that's not too dissimilar to what working people do with their income. If you're a working person with some type of volatility in your income, maybe there's certain years that you get big bonuses and certain years you don't, certain years you get fat commission checks, certain years you don't. People often do this in an unplanned, ad hoc sort of way. People often just kind of spend more in the years that they make more and spend less in the years that they make less. And that's sort of a natural response to shifting income. And so I think Paul Merriman's approach is just taking that natural response and then applying it to market withdrawals.
The other thing I like about that too is it just creates this well-rounded adventure. There's so many things. Paul talks about travel. There's so many opportunities that are low cost, and there's so many opportunities that cost a lot. Like I feel like you get this fun buffet of high ticket items mixed with just zero cost fun, like going on a hike or, you know what I mean? And they're all fantastic. And to have the serendipity to have it just happen as the market forces have it happen is pretty cool.
Yeah, I mean, you think about enjoying New York City, you could go to a Broadway show, which is hundreds and hundreds of dollars. You could take a long walk through Central Park. I frankly derive an equal amount of enjoyment from each. And I'm glad that my life is able to do both, but certainly you can do one when the market's good and the other when the market's bad.
Yeah, this is so fun. How about what's the one beautiful green space above the city, the High Line?
Oh yeah, the High Line, the Chelsea High Line.
Yeah, I mean stuff like
Yeah.
that.
That was designed by the same architect who made the Atlanta Beltline. So shout out to all my Atlanta people.
Cool. Yeah, really some fun stuff that you can do, to your point, for nothing, next to nothing, and other things that, I mean, all the 5-star restaurants where you can, or Michelin star restaurants where you could spend an arm and a leg.
Yeah. There's Michelin star restaurants, and then there are also these like little hole in the wall places, right? Yesterday, I had a slice of pizza, like the kind that you have to eat standing up because there's nowhere to sit at the little counter. And I mean, I would recommend that anybody, Prince Street Pizza, anyone who comes to New York,
Heaven.
yeah, grab a slice. It's great. There's nowhere to sit, but it's amazing. I'm talking about New York City because I think it's a microcosm of life in that way. There are so many things that you can enjoy, that truly enjoy at every budget level, whether it's free cheap on one end or massively expensive on the other.
And having the ability, like they will, to go back and forth, to dabble, totally fits the Joe Saul-Sehy approach to life. Like completely fits my ADD.
Nice. Well, Joe, I think we've done it.
No way. Already?
Yeah, we
That was
have. And
super fun.
so speaking of you and your ADD, where can people find you if they would like to know more? And by the way, we are not cracking jokes. Both of us, both Joe and I, have ADHD diagnoses.
What?
So just to put that out there for anybody who thinks that we're cracking jokes about neurodivergence, we are not. We are
Not at all.
Yeah.
Not
Yeah.
in the least. Come out to dinner with the two of us. It is
Yeah.
a wide-ranging squirrel conversation.
Yeah, exactly.
You know what I'd like to talk about? If you want to read my work, I have this book that CNN, the year that it came out, 2023, called the #1 book on personal finance that you should read. It's called Stacked, Your Super Serious Guide to Modern Money Management. The reason I'm bringing this up today, Paula, is because of the fact I just found out that our local university here, Texas A&M, Texarkana, is going to use it in their curriculum in the fall.
Amazing.
Which I have been hoping, because as you've seen in the book, it's totally made for that. It's an end-to-end personal finance journey with lots of relaxed metaphors in it. So, by the way, if you are working with a university or a college and you want to talk to me about how to get that done, or you want to have me come talk like I just did at UC Santa Barbara, just write me, joe@stackingbenjamins.com. So,
Right.
yeah,
And
how about that?
If you read the book Stacked, pay particular attention to page 13.
Lucky page 13.
The best page in the book, I must say. You
Yes.
might notice somebody quoted.
And even after that quote, we do interviews with experts from across the field of personal finance. And the very first interview that we do from the show is actually, it's funny, it's an Afford Anything segment with you and I talking to one of the Afford Anything listeners.
Ah.
So good stuff. Anyway, Stacked, and I'm super excited that this is going to appear in a university near me.
That's amazing. Congratulations, Joe. Well, thank you to everyone in the Afforder community for being a part of this community. If you want to talk to your fellow peers, head to affordanything.com/community. It is absolutely zero cost, and it's a way for you to connect with other people in the space. You can talk about retirement, you can talk about debt, you can talk about student loans or saving for college or anything that's on your mind, efficient frontier, asset allocation, you name it. It's all in the Afford Anything community, absolutely free, affordanything.com/community. Sign up for our newsletter, affordanything.com/newsletter, where we send out special updates of things that we don't write anywhere else. So you only find it there, affordanything.com/newsletter, also completely free. If you enjoyed today's episode, please share this with the people in your life, your dog walker, your barista, your boss,
your podcast co-host.
Share it with your own podcast co-host. Share this with your financial advisor. Share it with your accountant. Share it with
your accountant's mom.
Yo, I've never met my accountant's mom.
Well, there's an opportunity.
Oh, now I've got an icebreaker. So yes, share this with all the people in your life. That's the single most important thing you can do to spread the message of great financial health. Make sure you're following us in your favorite podcast playing app. And while you're there, please leave us up to a 5-star review. Thank you again for being an Afforder. I'm Paula Pant.
I'm Joe Saul-Sehy.
And we'll meet you in the next episode.